Today's show is brought to you in partnership with Clearmotive Marketing. I co-founded this high-impact creative agency over 15 years ago. We deliver marketing that matters to our clients through our three-pillar approach. Number one, research that delivers actionable insights. Two, creative that attracts and engages new customers. And three, which is the backbone of our client success, the people, process, and technology that ensure efficient, consistent, high-quality results. We have great ideas and incredible creative, which is expected from a national agency. What makes us different is that we also simplify workflow, use technology to speed up projects, and recommend activities that achieve higher returns. There is a mountain of work that happens behind the scenes to produce what our clients take for granted, and that's exactly how we want it. Because great creative combined with well-organized operations is why we have such long-standing relationships. For example, Honda Canada has renewed their contract with us annually for the last 12 years. Our clients are market leaders, so they're incredibly competitive. Efficiency, performance, and consistent results are the only way to get to the top and to stay there. If you're not getting the consistent results you need, I can help. Reach out to me on LinkedIn or check out clearmotive.ca. Hello and a warm Collisions YYC. Welcome to my guest this morning, Mr. Darcy Tuer. How are you doing, Darcy?
I am great. Thanks, Tyler. How are you doing?
Oh, man, I'm fabulous. It's so good. It doesn't seem that long ago that I had you on. I love having people back on, and I'm always looking for something happening or going on with their business. And you had a big, milestone, which we're going to get into in a second. But let's just start off. Let's let everybody into the tent. You are CEO at ZayZoon. What is a ZayZoon? What do you do? What problems do you solve in the world? If anybody in Calgary doesn't already know about you, let's make sure they do.
Yeah, well, my pleasure to share, of course. So Darcy Tuer, co-founder, CEO of ZayZoon. We've been around for 7 years, and really our focus has been around the problems that ensue by way of people living paycheck to paycheck, right? So a huge portion of the population in the US, 63% of people are paycheck to paycheck. So basically, if something unexpected happens from, you get paid, let's say every 2 weeks, 1 week in, your car breaks down, you don't have the means to repair it. And when we looked at this and we saw how pervasive this problem is, we started to get more curious around, what's available to people if your mom and dad aren't there, right, to get you out of the jam.
If you don't have a support network. Yeah.
You got it. And what we discovered was what's available to people is just awful. Payday lenders, people NSFing, overdrafting their bank accounts. Banks in the U.S. make over $20 billion a year on those nefarious charges. And
it would almost seem like there's low incentive to fix the problem from their perspective.
Yeah, from their perspective for sure. And so we thought there must be a better way. So Tate Hacker, my co-founder, actually came up with the concept, shared it with me as I was exiting my previous startup. And I was like, how has somebody not thought about this before?
One of those, like, this must be already happening, right?
Yeah, totally. Like someone must have dealt with this. And, really in some ways it's certainly an improvement or disruption to payroll. And payroll has been the same for like a century. So how in almost 100 years has somebody not said, there's a real problem here? And certainly the problem's been exacerbated over the course of time. Like over the last few decades, there's been a real separation between cost of living and income in a bad way. Costs have gone up, income has not gone up commensurate with those costs. So that's certainly created this financial epidemic that, like I said, 63% of people are dealing with on a daily basis.
And from a business, this is not a payday loans company. This is, and I've been doing some creeping as I always love to do, but this is the earned wage access, which how new is that category versus we've all heard of payday loans. We've all seen the cheesy commercials on TV. I think as an agency, we might have done a few years back, but the EWA category, just giving a little bit of history, because I always appreciate when a disruption comes, it's not always in the form of what it was. You've got to disrupt it by creating a new category.
Yeah, exactly. When Tate came up with the concept, and we brought on our co-founder, Jamie Ha, our CFO, we started looking at this, and it was not a category at the time. And so we certainly believe we were one of the pioneers for this particular category. And really the difference is in the name. So a payday loan is truly a loan. So you're borrowing from your future self. So you're in a pay period, but you really just need money. You're hung up. And you go to a payday lender and they look at securitizing your future earnings against a really high cost loan. And the high cost loan is and you look at it and it's like, wow, that's egregious, but it's really a byproduct of their business model being encumbered by a tremendous amount of risk. So what that means is they lose a lot of money, so they have to charge a lot to make money. And so what that actually translates into, the good customers that pay them back have to pay a tax for the customers that don't pay them back. And so I always say this, I always say to my kids, and I think about this for myself personally, you make decisions every day. When you make a decision, think about the impact on your future self. How's your future self going to feel about this decision? So I need money today, and maybe I have no choice. I have to go to a payday lender, but that means 2 weeks from now, a month from now, and probably on a perpetual basis, I've really created a challenge. And for many people, it's a debt spiral when you take on that payday loan. So the difference with ZayZoon is that word loan. We are not a loan. You have earned your money. You've worked hard for your money. Your employer just happens to pay you every 2 weeks, or in some cases, every month. And so you effectively are a creditor to your employer because they owe you money. Yeah. And so think about the contrast. Like your employer owes you $500. Your car broke down, you need to pay $500 to fix your car. But your employer, just because they're managing their own cash flow, because of payroll cycle.
Well, because the way it's been done for a century, to your earlier comment.
So it's okay, because that's just what the construct that we know. And I think some of the best ideas, certainly Apple's mantra, like challenge the status quo. So, this
is the way we've always done it, as a reason to take a shot at it, right?
Yeah, right? Yeah. And so ours is quite simple. We are stepping in as an intermediary to provide you with those hard-earned funds on behalf of your employer. Because employers in many ways are as financially disempowered as the people that they're paying, especially
there's a chain of events depending on who's paying your employer when they're paying. Everybody's managing each other everyone's treating you like a miniature bank at one point or another, right? As a business or an employee, or you're just extending that out. We've all sent invoices and got paid 120 days later, but yet my employees need to get paid at the end of this month or every 2 weeks, right? So it perpetuates on itself, I would say.
Yeah, that's exactly right.
So let's talk about the huge win you've had recently, and I'm calling it that. I assume that it would fit in that category. You had a Series B round of 34.5, which I want to get into that, but I also want to pull back a little bit, like that 34.5 versus some of the earlier raise when you were the new player in maybe a very unknown category. Just even talking about the dichotomy of how it's progressed for you guys over the last 6-7 years.
Yeah, well, so when you think about raising capital, especially with venture capitalists, you've got to really think about your audience, right? In any case, when you're dealing with a counterparty, you need to think about your audience. And when you think about venture capital, like I think the very best VCs look at opportunities, and what they do to be efficient is they find a really fast path to disqualify the opportunity, right? Because if you think about the deal flow that they get, a lot of VCs are looking at 400, 500 deals a month, but they may only invest in 2 or 3 a year. So the top of the funnel is huge. And so in the early days, to answer your question around how did it change, when there wasn't a category, and I said, well, we're going to be the category leader.
Click out.
And they're like, what category are you talking about?
Help me understand where to put you. I can't figure it out. I put you over in the do not apply column.
Yeah, we're going to win the miscellaneous category, so no one ever.
Yeah, touche. Mm-hmm. How efficient we get at weeding out what, just by the amount of sheer messages we receive every day as humans, let alone in a VC environment where everybody is the next big thing from their side to them, right?
Yeah, and the other thing to remember, VC capital, and when we chatted about this in our previous session, we hadn't taken on institutional capital. It was all really through our network. It was through quasi kind of family offices, the intergens of the world that are there to support us, but they're not strictly, or they're not AVC, right? And when you think about it as an entrepreneur, and this is important for those entrepreneurs and future entrepreneurs that are listening, only 1% of the capital that gets deployed to startups is through a venture capitalist.
Oh wow! I've not heard that number. Wow, that's
so we romanticize the label, the achievement, if you will, of getting VC funds. But you're really setting yourself up for, and this is what almost happened to us when we didn't get VC funding in the previous round. You almost set yourself up for a binary outcome. And I think so we almost died because we set ourselves up for a binary outcome with our Series A, right at the end of 2021. And then I kind of saw a little bit of a shiny alternative, which was, hey, I believe in this business. I'm going to put my money where my mouth is. Tate is, Jamie is. And that's going to send a signal that we believe this. And if the VCs disqualify us because the category hasn't been formed, that doesn't mean we have to disqualify ourselves. And there are 99% of the capital out there isn't VC capital. Let's go find that. So that's
interesting. And was that an epiphany moment of like, whoa, well, I see the wall coming at us. We need to make a right turn or a left turn. Like thinking back to, you get an idea in your head of this is how it's going to work out. And then all of a sudden it's like, whoa, I'm starting to see, like, do you keep the head down, ass up? Or do you go, whoa, this dashboard doesn't look good. I'm being forced to kind of reassess how I reframe the whole thing.
Tyler, like you nailed it. The walls were closing in. So we had, like, think about this. We had 33 staff at the time. We were serving 10,000 customers at the time. Our business for the last 18 months had been growing 10% per month. So we were tripling the business year over year, but I could not get capital, and our runway might have been 6 weeks.
Oh, wow.
And it was Christmas. Real. So here we are at Christmas.
Oh, so this is the timely, and for everyone listening, we're recording this like 3 days before Christmas 2023.
Yeah. So Jamie and I actually just did a roadshow. We put our own money where our mouth is, and in 3 weeks we raised $12.5 million from non.
And that was back in 21.
Yeah, end of 21. It took us 3 weeks, and so we went from thinking we were going to die. The walls were closing in, and then I did have an epiphany, and I remember calling the boys. I remember calling Marcos Lopez, my board member, and just incredible supporter, mentor, and said, "Hey, what if we lead this round? Like, damn the people that don't get it, or shame on us for not having explained it, right?"
If this is a movie, this is the turn. This is where the story turns, right? It starts heading in a new direction.
Yeah, the music gets intense.
100%. So you went out and you just started past relationships, calling, phone. Hey, do you know somebody? Yeah, refer me here. Pass me on. Oh, open a door. Was it literally as grassroots as that?
Absolutely. Like Jamie and I we'd start our day out and we would just go like around Calgary. Remind me my old Spira startup days, like, because our clients were all in Calgary. We just wander around the plus 15s and
go to the hunting ground. Yeah, totally.
So this was the same. It's like, hey, Tyler, okay, you're not willing to write a check, but do you know someone who would? And you're like, oh, I know this guy over here who works in this family office, and could we buy him a coffee? And and in 3 weeks we'd raised $12.5 million.
I love that story because it's so. I love these stories because it's so easy to look at the end and go, oh, wow, but so fortunate. Wow, it all worked out. The story behind the story is always where the nuggets are, where the learning is. Like, oh yeah, you think it's all great. What about that time when it almost blew up? What about that time? No one talks about that when they say how lucky you are because you raised 34.5. And did that 12 all come out of Calgary? Did that all come out of quote unquote the community?
Yeah, 95% of it certainly came out of Calgary. Yeah, and that's why I always talk about Sandy Gilbert. I talk about Marcos and his group, like the former Solium Shareworks gang. Massive.
I'm a big fan of Sandy. I've had her on a couple times. She's a force. She's a force of nature all of her own.
Yeah, the community owes her for just everything that she's done and is doing.
Unrelenting.
Yeah,
unrelenting energy. So that's 21. You raised it. You raised the 12, and from a format you gave up that was dilutive, non-dilutive, like what did that still leave you whole in a place that sets you up for the next? Because I've often heard entrepreneurs on the show be like, hey, be careful, this you got to think about the next move on your pool shot, because if you blow it here, you can really hurt yourself down the road.
Yeah, and there's two ways to do it, right? So we're all reflective on ZERP, right? Like, no money was free, valuations were out of this world. So I actually think we got lucky by not getting institutional capital in 2021, because I bet you would have been at a 20, 30, 40x run rate, right? Like just a totally unreasonable valuation, which for your ego at the time and the amount of capital you can raise against
back to your future self comment,
you got it. And so I get to read the press clippings that were valued at hundreds of millions of dollars, and we've raised this money, but my future self then has a massive pref stack I have to outrun for my common shareholders, for the people around Calgary that we passed the hat out to. So I think where we got really lucky was we were always forced to do it in with rational metrics
with common sense and reason. Darcy, that sounds crazy. Yeah, right? During that period of time in 21, early 22.
So we priced the round. Like Jamie Haw, former investment banker, first 15 years at First Energy, and so he took a very traditional approach to here's the valuation, here's what our projections are, here's a discount, like a discounted cash flow model, here's what we're seeing in the market in terms of what we think is realistic, and then recognizing you don't want to dilute yourself to a point where you end up with such a small portion of the company.
You lose the juice, right? Yeah.
You lose the juice. And the work, it's orders of magnitude more work than a normal job. Like, let's be honest. So the outcome
also has to have orders of magnitude more potential.
To be commensurate. Yeah, exactly. So, but you also, and this was lost on people, I think, until now, and me too. I think I just got lucky I didn't end up with this inflated environment. So now I look at our cap table and the pref stack, and I'm like, I can outrun that. Like in my mind, I'm like, I can outrun that in 6 months, right? And
how much of a value proposition, like what, aside from the business and the growth and the roadmap, we'll talk about that. But when you went to market for the Series B, I'm assuming that that story, that groundwork really set you up for that next round.
Yeah, it did. I think the discipline, there's this kind of dichotomy when you're, I think, a Canadian tech entrepreneur. Because one thing we did, and we've always done, is we put a plan together that we believe is achievable with stretch in it. But typically I put forth to our investors, here's the plan, and this is non-negotiable to me and the team. Right? We have a high degree of confidence we can hit this plan. And then internally, I'm like, hey, I'll add 10% to that plan and be like, hey guys, this is non-negotiable. And that's pretty, I think that's a good model to go. And everybody knows that's kind of how I do it. And what we've done, Tyler, is so we'll tend to, so the last 2 years, we've tripled our business year over year, the last 2 years, probably 3 years actually. But that was always the plan. But I think when a lot of people present to an institution, they're like, we're going to 5x the business this year with your
tendency
capital.
to overstate
we're going to
the hand.
10x.
Yeah,
but 12 months goes by in the blink of an eye. But what the disservice to us when we were speaking to institutions originally was, wow, these guys aren't aggressive enough. But what happened was, we've spent years building relationships with institutional investors. And so when our investor came in the Series B round, what happened was, and their story back to us was, which I loved, they said, we've met with you, we look at our notes, and VCs, especially the good ones, take very detailed notes, and they run the data, and they're running this against really standardized models on valuation and market, etc. And our investors that came in, they said, we met with you 4 years in a row, and every time we met with you, you said you're going to do a thing, and then we discount that, right? Because everyone says they're going to do a thing, and they do a third of that thing, or lots of people. And they're like, by the fourth time we met with you, every time we looked at our notes, you guys had exceeded what you were going to do. And so it got to the point where we're like, we just had to believe you. And if we waited every time we wait, it just gets more expensive for us to get on the journey with you.
But that took 4 years though. I really appreciate the overnight 4 year, or many, many more than four, but that's the value of looking at it from the outside, thinking it just happened. And I know we're not that oversimplified, but it's easy to make that mistake. The Hollywood version of in a 2 hour story arc, it all worked out. It's not how it goes. So I literally love the 4 year story behind that because it's honest.
Yeah, it's reality.
And just even thinking about going from the Series A, raising the 34 for you guys, because I've had said to me before from VCs, they're like, hey, you know what? Your goal should be to not take my money if you can do it on your own. But I also appreciate that there's just the reality of growth takes capital and you've got this momentum. Just talk to me about the decision of even going in and to taking on more money to potential dilute or just make things more, quote unquote, more complicated.
Yeah, this was a gut check moment, Tyler, because we actually didn't need VC money. So you'll hear this often.
Best time to get money.
Best time to get money is when you don't need it. And so we were on a path to positive cash flow. And everyone, you could say that, but we literally were. And ironically, when our Series B funds hit the account, which you don't close until the funds in the account, you've got like 6 more days, right? And then
we've all been in sales long enough. It's not a done deal till it's a done deal.
Yeah, that's right. And so when the funds hit our account that month, we were positive EBITDA, and I was like, yeah, of course, we're positive EBITDA now. We've got all of this money in the bank account, and you've obviously got to use the proceeds. You've got to plan.
Yeah, you got to put that into play because we want to see action now, right? Activity.
So here was a gut check moment. I sat down with Tate and Jamie, and because we went to market, and then I'm like, oh my gosh, there's interest, and it was a competitive process. And I said to the boys, I'm like, okay. So now we hadn't even set up a data room because we're like, we'll just test the market.
Yeah, go out and just feel it out. just go take a walk in the woods and see if you see anything.
Yeah, and then so my team, and we're so busy. We tripled the business this year. That took a tremendous amount of work and hustle.
What's your head count now, Darcy? What are you guys up to?
We're 105 right now.
That's a real number. It's a lot. That's a lot of bodies. That's a lot of humans.
Yeah, it's a lot of responsibility.
I appreciate that.
And so I said to the boys, I remember just sitting down and I said, okay, if we do this, we're making a decision, because by way of taking VC funds, they've picked you, they've tried to find a reason not to invest and they couldn't find one. So they're investing, but their investment thesis for every investment a VC makes in general is they want that investment to return their fund, right? And so they're not looking for a 3x or a 5x, right? Like they want a 20x on that investment. They're going to invest.
Back to even your profile around payday loans, are like, it's riskier dollars, so therefore the yield has to be high. Like that is it's the formula kind of pulled out from another perspective, right?
Yeah,
same but different.
Same but different. I remember Pat Lohr. One day we invited him into our office in the early days, and he walked a bunch of us through like that portfolio theory, right? Like this is, a VC is going to make 20 investments, and out of that there might be 1 or 2 unicorns. There's going to be a few that'll provide a 3x or 4x return, but like they're really built to. And think about that. That's the 1% of capital being deployed into those 28 investments, and only 2 of them are going to provide the percentage of the percentage if they're lucky, right?
Yeah,
or if they're good, I should say, and maybe
a little bit good and a little bit luck. You can never totally unrule luck from the equation. Luck, good or bad, sometimes too. I know we don't. The rational among us never want to use that as a story, but sometimes.
Yeah. Now, okay, it takes me a long time to answer a question, but so Tate, Jamie, and I said, "Okay, boys, like this, we are now going to have to swing big." And we've been swinging big, but we've actually built a lot of enterprise value for our employees, for our families.
And what sounds like a very disciplined but very consistent yield and approach that you've taken.
Yeah, totally. So we're on the path to positive cash flow. We've built something that there's a tremendous amount of value for all of our stakeholders. And everyone, we hadn't taken on VC investment at that point. So, our early shareholders would get a wonderful return. So like we could put this thing up for sale.
And you were about to change the cards. You're about to change the deck, right?
You got it. And so I said, we have to be very, very deliberate. And we have this, where there's a fork in the road and there's a left and a right. And are we willing to take that right, the path on the right, which is we need to create a multi-billion-dollar outcome for our investors, and it's a different road. Here's what this looks like. We're going to be 300 people in the next 3 years to get to X run rate, to get to Y enterprise valuation. That's it changes the talent you hire. It changes how like you're working hard, but you have to work harder or as hard, but also level yourself up. Because for me to be the CEO of a 100-person company, that's different than the CEO of a 150-person company or 200-person or whatever run rate you're managing, right?
I really appreciate the human side of what you're talking about. I'm like, yeah, okay, well, absolutely chase the golden ring and just do the thing, because we get so programmed, versus stepping back, go, wait a second, what do we want? What are we willing to sacrifice to get? And lifestyle and hours and family time. And like, there's so much more to it. I appreciate that you guys sat down and had a little fireside about that, because the easy capitalist in us is like, absolutely, why would you never? Well, still, let's just make sure we know what we're agreeing to before we agree to it, right? And I really appreciate that human side of that conversation.
And I guess like the rationale, I think it's important I mention this. It wasn't about doing the math on like what we think our equity is going to be worth at a $2 billion outcome. It was actually the $2 billion outcome means that we are impacting 700,000 customers. We're improving the financial health and security of 1 million customers, let's say, right? And so then you're connecting your legacy to impact, of which certainly the byproduct of that magnitude of impact is going to be wealth creation for all of our investors and everybody that's been part of this.
But there's
journey.
a longer tail to your business, which I appreciate. It's not just what's in my wheelbarrow at the end.
Yeah, and
what's in my bucket? I guess maybe it's because you can fill your bucket up with different things. Totally,
and like we align on our big, hairy, audacious goal, the BHAG, which is save 10 million people, $10 billion, and we track it. So this year it's hundreds of thousands of customers.
Well, pick a key result and then measure it, right? Absolutely.
Yeah.
I love that. Like, so what I'm hearing was you took the time, you were very disciplined. You had a roadmap and you delivered on it. I love the 4-year story of like, well, we're seeing you guys again. And yet again, you're doing what you say, just for anybody listening. And you built those relationships over time. And, you built the relationship before you needed to make the ask, and how critical it is to do that. But I do love that when it was time to, 6 weeks and the wall is coming right at you, you just got out there and you pounded the pavement, pressed the flesh, all the cheesy metaphors that are used for that. But I really love the grassroots side of that nothing easy about it, and also like hard work and just putting in the time. Anything you would do different around the series, the Series B?
Yeah, what I would do differently would be running a more structured process. So remember I said we just kind of put feelers out, and we're so heads down in the business, which I love. Like, that's my favorite part, is building the business with the team, right? Raising capital is not, it's another job on top of the job you have, and it creates a real
You're not the only founder who said that. Like, I was like, I felt like I was duct taped to my office chair and duct taped to my Zoom camera for 4 weeks.
It was 8 months. It was 8 months from deciding to put the feelers out to the money in the bank, right? So you've got a tremendous amount of diligence, negotiation. You sign a term sheet, and I think a lot of people think that's the win. I felt like that was the win, and then I was like, there was actually another 80 days.
That was the start. That was actually the start of round 2.
80 days of work, because even like, and this is good for founders to hear, when you sign a term sheet, you've signed it with a lead investor. Well, very rarely is that lead investor funding the entire round, right? So you're setting a whole second tier process starts at that point. Yeah. So then they're like, find a secondary or find a follow-on investor, and is that on you 100%, or do they tap into their network as well and open some doors? Yeah, they absolutely tap into their network, but it's not. They don't remove as much friction as you might think. They're really just creating the intros. It's not a guaranteed yes, is what you're saying. Yeah, that's right. And so then the institutions that follow, they'll count on the primary institution, the lead, to do the negotiation, to set the terms. Like, that all gets established. And you're getting access to the back room. You're not getting guarantees. Like, you still have to earn it. You got it. Yeah. So a tremendous amount of work to get there. And then you have to remember, the longer it takes to close, that introduces deal risk, because there's no guarantee. More things change. And doing the background on the VC, our lead was Framework Ventures, who are incredible, by the way. But they were so diligent in their diligence up to the term sheet, like their close, a good question to ask is like, what's your percentage close rate from executing a term sheet? And for them, it's nearly 100%.
Oh, interesting. So by the time they take the term sheet seriously, is what you're saying,
yeah,
versus
yeah,
versus getting you locked up and then 80 days goes by and kind of things.
Yeah, you're locked up, right? And there's it's not legally binding, and so you could you imagine that it doesn't happen 60 days in, and now you have to restart everything, and now you've got kind of like the strike against you for the
and arguably, depending, you've now been distracted from your business, from your core day-to-day tasks. Hopefully not, but like you said, it's another part-time / full-time job while you're doing that on top of the stuff you're already doing, which is running your business, right? Mm-hmm.
Yeah, that's exactly right.
So for you guys, just in terms, you mentioned we didn't have a deal room set up. We kind of just went to put our feelers out based on your past rounds, based on like, I guess, that level of organization that you recommend, like before going out. Sounds like you went out just to feel, and all of a sudden it's like, well, we've got interest now. We got to backfill and get our shit together to get all of our like just how much time and energy. And do you recommend doing a lot of upfront work before you know there's interest? Or I guess it's situational, but
yeah. Like my recommendation would actually be like when you're not even ready to do VC funding, like when you're just thinking about it, my recommendation would be start building the network and then start figuring out from the VCs what's important to them. Because they're smart, like they get a real
and they do
sense. This
all the time. You do it every couple of years, right? Just to think about volume.
All the time. Yeah. And so I'll give you a really good example. I remember talking to a tier 1 VC out of the US, like just so intimidating. And the first question he asked me, like this was an unbelievable question, and it was like such a basic building block question. That I bet you most founders can't answer.
Oh, I love it.
So when you spend $1 in your business, when you burn $1 in your business, when do you get that $1 back in gross margin? A lot of people cannot answer that.
Yeah, my brain's spinning right now.
Yeah. And so that's really important because that's the economic engine. So I'm spending, like if you think about the capital you deploy in your own business, obviously the whole purpose is to get a return on that invested capital, build enterprise value, and create that separation from the value today and the value tomorrow, and then ultimately monetize that value for your investors. And the definition of a successful tech company is not getting to 100 million in revenue. It's providing a return for your investors.
So when you spend $1 in your business, you burn $1 in your business, when is it returned in gross margin? That's it.
Yeah.
There's probably a few people listening right now with their, do I reach for my calculator? Do I call my CFO? How do I approach that question?
Yeah. And then, to get back to the original question, when and how do you start preparing the data room? And it's kind of like board meetings. Everything you have in the data room or anything you're going to prepare to the board should actually just be what you use to manage your business. So I want to know my sales efficiency. So what's my sales velocity? What's my return on sales and marketing investment? So for every $1 I spend in sales and marketing, I want to see at least $2 in ACV, right? And annual contract value. For what's my burn rate efficiency? So like in my business today, I have to burn 25 cents to make $1. Well, that's a wonderful efficiency, but as you take on capital and you hire more people, your burn rate goes up, and then it starts to shift, and that's okay for a time, but your job is to get that burn efficiency back and ultimately then establish a direct line to positive cash.
While recognizing the gains that it created in the interim of having those extra bodies and that extra capacity, right?
You got it. And then so ultimately building out the data room, that should be a byproduct of how you manage your own business. Now, it's not going to be. Like if you're a seed stage company, you're not going to have that discipline. You're not going to, it might not even make sense.
What I appreciate is don't get caught up thinking it's something totally different, that there's more similarities than there's differences, if I'm hearing what you're saying.
Yeah.
It's like, I have to do this whole separate thing that'll just sit there and get stale. But no, because it is how you're actively either communicating with your board or what you actually are caring about in your business.
Yeah. Like I think a good example for the board is at the end of every month, like you have your leadership review of like the key metrics in the business, how you're doing on your key initiatives, where maybe there are certain issues, your KPIs, right? Capital efficiency, runway, all of that stuff, leading indicators, hopefully as well. That gets disseminated to the board. And then your board meeting is really just an aggregation of that and hopefully a distillation. And then you've got some core issues and opportunities to discuss. But it shouldn't be a lot of work. Like Sean Abbott wrote a wonderful article on like board governance and how like a functional board should work to be additive rather than just kind of extra lift and overhead to the management team. Now I'm saying that, and my board members that might listen to this are like, yeah, well, Darcy, like we're not there yet with ZayZoon. I've had a lot of board in 7 years, right? But we get better the point is like, continue to get better every
I'm okay to talk about it from an aspirational perspective and know that, yes, this is what we're going for and we're not going to be perfect. But to your point, if you don't know what you're trying to hit. I appreciate just breaking that part because it's easy for someone who's not gone through it. I've done it at a small scale, but to think about it as this big daunting thing, which it is, but how do you make it more comparative and collaborative with how you're actually already running your business? Yeah. And it shouldn't be a whole different set of metrics because if they're thinking this is important and you're not even tracking it, that already doesn't make sense, right? There's already a gap. Mm-hmm.
Well, let's talk about Sandy again. Sandy has this amazing fintech startup. They won FinTech of the Year this year.
And they've been around for quite a few years, like 10 years.
DealPoint, yeah. So we use DealPoint. They help you set up your whole data room, provide access, dissemination of
That's an excellent plug for Sandy. Well done. Well placed. Well done.
I owe her, but it's
100%. But yeah, that's like talking reference. About this exact task. That's where you can go to have get some support. Mm-hmm.
Totally right.
A little bit just for the roadmap is, marketing, product, tech. How is this Series B getting deployed? Like, what's kind of some of the key milestones that you've got now that it's landed, it's in, and now we're like, okay, now we got to do the thing with the grist for the mill, which is the funds. Mm-hmm.
Yeah. So we all know kind of the journey of Series A. You've got product market fit. You've got a general thesis around like, here's our customer acquisition costs, here's our LTV, and we've got maybe not statistically relevant data, but we've got enough data to like connect the dots, right?
To know that we're somewhat pointing the gun in the right direction.
Yeah, and so Series A, they're really still looking at the team and saying, this team has not figured it out yet, but they figured out a lot of things. And there really seems to be this like really positive signals on product market fit. And they're kind of they've got conviction and they've got some really good, like intellectually honest thinking around how they're going to grow the business and the addressable market and what they're going to win. Series B, you've got to demonstrate more of a codification, more of a framework around this. Here's how this is working. We're scaling, right? We've got tremendous growth, and you actually need to demonstrate capital efficiency at that point, and then you need to show that you can preserve capital efficiency to get to a really meaningful run rate, like revenue run rate, and line of sight to, like, if you've got capital efficiency and you can grow efficiently, then ultimately you get line of sight to positive cash flow. And then enterprise value creation is a few things. So it's predictable revenue growth. It's showing meaningful unit economics and hopefully a line of sight to improved unit economics, especially in fintech. You've got the ability to ideally like win a category. That's really, really important for VCs because they're not going to get that 20x if you don't end up being the category leader. You can't be an also ran company. You've got to be like, I always say, we're going to be the Kleenex of earned wage access for our category, right? For the SMB category. And then you want to show a level of sophistication where you can leverage like the data that you're capturing in your business to drive more efficiency. So sales, growth, efficiency, customer impact and delight, and other ways to inform how you're going to improve on that product experience by either making your product better, improving ARPU, so average revenue per user, or even deploying another product, right? That's going to help drive ARPU, help provide competitive advantage. So those are the boxes that you want to check for enterprise value creation post Series B. And that's all hard work, and they kind of work against each other because you're also managing risk in the business at the same time. So you're trying to grow, you're trying to build out the supports internally, because the scale up means you're doing more with less. And so that means you're now looking at systems, you're looking at revenue per or margin per full-time employee. So at our run rate, I'm proud of only being 105 people. I know there are companies a lot smaller than us that have 200 people, so I'm proud of that, but I'm also seeing people break and systems break.
You have to realize that there's what's the corresponding potential cost for risk to
you
that,
got
right?
it. Yeah.
Which ultimately we're still just a bunch of humans having a messy experience. And then how do you manage that?
Yeah.
And if we burn each other out, that's you're playing the short game.
Yeah. Perfection isn't the goal. So you need to manage and understand your priorities and risks, and make sure you're investing in those, and that you're not spread too thin. I think it always sounds like a lot of money when you raise, but then you put your budget together and your plan, and you're like, oh my gosh, like there's still a lot of scarcity.
we could have got more
in this.
Yeah, money and horsepower. Too much of it creates other problems, but at the same time.
Yeah.
Where is Framework Ventures? I don't know them. Where are they based out of?
They're based out of Toronto.
Okay. TO company.
Yeah.
Any challenges or any being a Western Canadian company when you're talking to VCs? And I've chatted with, but this is probably a year ago. I had some conversations about companies here in Calgary that, went to raise and they basically could hardly get a call back here. They had to go to Toronto, and then there was some actually pretty solid interest. Helsum has some stories like that. Anyways, I'm curious about that journey. Was that just who showed up at the table? And I know most of your work, is all in the US basically, right? So
yeah, we're 100% in the US.
Okay. 100%. I think I probably asked you this on the first call we chatted about, so I can't help but circle back to it. Doesn't sound like any disadvantages or to any effect of actually being based here. I think we got into this much on a deeper level in our last show.
Like having Neo here and Cement, companies that have raised a tremendous amount of capital, those guys, and Absorb and Solium Shareworks and Benevity, they started to put Calgary on the map, and now
which is great. We're getting further down that cycle of our ecosystem being quote unquote new from the text-based perspective. And
Helsum, like Nick and I chat lots because we're very similar.
Nick's a good dude, man. I got a lot of time for Nick. He's great.
Yeah, he's great.
So interesting to hear, and so good to. I enjoyed our last conversation because you have a very business side, but there's always a little bit of philosophy in terms of how you tell the stories, which I really love. The business philosopher, because there is a blend of both, and there's the hard numbers, like you said. There's the journey that you're on, and your love of I love being in the business, and this is a separate thing, and it's a different set of skills that I think for some founders, especially in early stages, oh shit, I didn't know I had to be good at this. That's a reality.
Yeah, well, something my VC said to me, at this stage, and it hit me really hard. He's like, your whole job now, Darcy, is people. It's people management. It's building out the right executive leadership team. It's making sure that people are aligned, and you building out efficient. And I'm like, oh man. I'm good. I feel like I'm good one-on-one, but it's
taking on it. Back, you said you have to I think I had an executive speaker years ago, and she said, most leaders at any one point will all of a sudden get this imposter syndrome of oh shit, my business needs somebody different. He said, argue, I think it was she said, I'll argue that you are still the best person at that time, and you just got to grow with it. And that easy, oh geez, it's not me, it's someone else. She goes, it's rarely someone else, it's usually you. And I that landed in my head kind of in correlation to your comment.
Yeah, you have to grow because you're dictating and predicting where the business is going to be. So then you have to work backwards on yourself and say, what kind of leader do I need to be?
What do I need to be there?
At 100 million run rate with 200 people, what does that leader need to look like? And then you're also working backwards on the plan, which is what team?
Yeah, it's what's the delta, what's the gap, all constantly.
Yeah, and so
back to there's physically hours, and then there's the mental hours of that as well, because it's a journey.
Yeah. Yeah.
Well,
totally.
congratulations. I love your story. I love our chats. I do love the full philosophical side of your nature, which is part of why I really enjoy. You give a broader perspective around it. And I like what you said. It's easy to go, oh, it's a big number. But what you shared with us today is like, here's a lot of reality behind it of how we got. And yeah, it's easy to shine a big light and it gets a headline, but there's a whole group of real people and a real journey behind all that, which I really appreciate. You bring that to the story, I think, really, really well. Mm-hmm.
Oh, thanks, Tyler. Well, yeah, it's always my pleasure to chat.
Right on, man. Well, congratulations. And hey, we're on a 6-month rotation now. So I'll see you in 6 months. I don't know, one way or another.
Well, we've got some exciting things.
Oh, nice. Nice. Getting teasers. Do you want to share? Anyone who's still listening, they're bought in at this point. They're 43 minutes in.
Yeah. Well, if you're a Canadian business owner, I'd love to chat. Or payroll provider. There's certainly, I think there's an incredible opportunity now in Canada in concert with the US. So that's something
interesting. So things are shifting. The landscape is shifting, creating some more different opportunities.
Yeah, I think it'd be a shame to do this and have impact in the US and not take this to our own backyard.
Well, based on your core North Star of what you're trying to do. Yeah, absolutely. Like, hey, who do you want to usually help most is the people at home, right? But it gives you a chance to broaden up the reach of that number.
Yeah, exactly right.
All right, well, stay tuned. 2024 is going to be awesome.
Yeah, looking forward to it.
Darcy, thanks so much, man. I really appreciate your time. And this will probably air in February, but we are right before Christmas, so happy holidays. And it was a really great chat with you. Thanks for taking the time.
Yeah, take care. All right, bye.